The Psychology of Money by Morgan Housel. Introduction. Money is often treated as a math problem. We assume that people who do well financially are those who understand markets better, analyze data more deeply, or make smarter calculations. But in the real world, especially in an economy like the United States, financial success has far less to do with IQ or spreadsheets and far more to do with human behavior. People don't make financial decisions based purely on facts. They make them through the lens of their own life experiences, emotions, fears, and personal history. A decision that feels completely reasonable to one person may look reckless or overly cautious to another. Someone who lived through the Great Depression, the dot-com crash, or the 2008 financial crisis will naturally view risk much differently than someone who began investing during a long bull market. Neither perspective is irrational. They are simply shaped by different experiences. This is why disagreements about money are so common. Two people can have access to the same information, the same financial tools, and the same opportunities, yet make opposite choices. When we forget that money decisions are emotional as well as analytical, we often mistake different behavior for bad behavior. In reality, most financial decisions make sense to the person making them. The fascinating thing about money is that it affects almost every part of our lives: security, freedom, status, and happiness. Yet we are rarely taught how to think about it. We learn how to calculate interest, analyze investments, and build budgets, but very little about how fear, greed, pride, regret, and patience influence our financial choices. Those emotional forces often matter more than technical knowledge. In a country where opportunity is abundant but uncertainty is constant, understanding the psychology behind money becomes a major advantage. This book is not about how to pick stocks or time markets. It is about how humans think and behave when money is involved, why we make the choices we do, how those choices shape our outcomes, and how small changes in behavior can lead to dramatically different financial lives over time. Chapter 1. No one's crazy. People make financial decisions that often seem irrational, sometimes even reckless, to outsiders. One person keeps all their money in cash, afraid of the stock market. Another invests aggressively, barely holding any savings at all. From the outside, it's easy to label one as too fearful and the other as irresponsible. But the truth is simpler and far more important. No one is crazy. People make decisions based on their own experiences, and those experiences rarely line up. Every financial decision we make is influenced by the world we've lived in. Someone who grew up during inflationary times may see debt as dangerous. Someone who started investing during a long bull market may see risk as something to embrace. In the United States, where economic cycles can change dramatically from one decade to the next, these differences are especially pronounced. A retiree who lived through the stagflation of the 1970s or lost significant savings in 2008 carries those memories into every financial choice. A younger investor, whose adult life has mostly known rising markets and easy access to investing apps, may have a completely different tolerance for risk. What's important to understand is that people don't react to the economy as an abstract concept. They react to their version of the economy, the one shaped by their personal wins and losses. That's why two people can look at the same market data and walk away with opposite conclusions. Each is filtering information through their own reality. This idea explains why arguments about money are often so unproductive. We assume that facts alone should settle debates, but money has never been just about facts. It's about what scares us, what gives us peace of mind, and what we believe will protect us from uncertainty. When someone makes a financial choice we wouldn't make ourselves, it's tempting to assume they're uninformed or reckless. In most cases, they're simply responding rationally to a different past. Understanding this changes how we judge others and how we judge ourselves. It encourages humility. Instead of copying someone else's strategy or assuming there's a single right way to handle money, we begin to see that good decisions depend heavily on context. A strategy that works well for someone else may fail miserably for you, not because it's flawed, but because it doesn't fit your temperament, needs, or experiences. Once you accept that no one is crazy, you stop trying to find universal rules for financial success. You start focusing on what works for you. And that shift, from comparison to self-awareness, is one of the most powerful steps toward making better decisions with money. Chapter 2. Luck and Risk. Nothing in money, and very little in life, is as clean or predictable as we often assume. We like clear explanations. Successful people are talented, disciplined, and smart. Unsuccessful people made mistakes or lacked effort. This way of thinking feels comforting because it suggests that outcomes are under our control. But in reality, financial success and failure are influenced by a powerful and often overlooked force: randomness. Luck and risk are two sides of the same coin. Luck is what helps good outcomes happen beyond our control, while risk is what allows bad outcomes to strike even when we do many things right. Both are always present, yet we struggle to measure them because they are invisible. When we look at someone's financial success, we tend to see only their skill. When we see failure, we assume poor judgment. Most of the time, the truth lies somewhere in between. History is full of examples. Think about investors who started their careers at the exact moment when markets began a long period of growth. Their early success builds confidence, encourages risk-taking, and attracts capital, all of which further increases their odds of success. At the same time, equally intelligent and hardworking people may begin their careers during recessions or market crashes. Their opportunities shrink, confidence erodes, and they are forced to play defense. Over decades, these early differences compound into dramatically different outcomes, even if both individuals made reasonable decisions. In the United States, timing plays an especially large role. Someone who bought a home in the early 2010s benefited from low interest rates and rising property values. Someone who bought a similar home just a few years earlier, before the housing collapse, may have suffered years of financial stress through no fault of their own. Skill mattered, but luck and risk mattered more than we usually admit. This doesn't mean effort and intelligence are irrelevant. They matter deeply, but they operate within boundaries set by chance. Ignoring that fact leads to flawed lessons. When we study successful people and try to copy them exactly, we often miss the role that timing, circumstance, and randomness played in their journey. We see the decisions that worked, not the equal number of decisions that could have failed if just a few variables had changed. This is why learning from others requires humility. Stories of success are useful, but only if we understand their limits. What worked for someone else may not work for you, not because you're doing something wrong, but because the world you're operating in is different. Blind imitation assumes that outcomes are fully controllable. They aren't. The same principle applies to failure. When someone fails financially, it's easy to attribute the result entirely to poor judgment. Sometimes that's true, but often, bad luck or unexpected events play a much larger role than we're comfortable admitting. Health crises, sudden layoffs, market crashes, and economic shocks can derail even the most thoughtfully planned lives. Recognizing this should make us more compassionate and more cautious about drawing conclusions. Understanding luck and risk also changes how we think about long-term strategy. If outcomes are partly random, then survival becomes more important than optimization. The goal isn't to make perfect decisions. It's to avoid decisions that permanently wipe you out. Financial success doesn't require being right all the time. It requires staying in the game long enough for good luck to have a chance to find you. When you accept the role of randomness, confidence turns into patience, and arrogance turns into gratitude. You stop assuming that past success guarantees future results, and you begin to respect the fragility of good outcomes. At the same time, you stop blaming yourself or others entirely for things that were never fully within your control. Luck and risk remind us of an uncomfortable truth. Outcomes say less about character and intelligence than we want to believe. But once we accept that, we can build better, more resilient financial lives. Ones that don't depend on perfect timing or flawless execution, but on humility, endurance, and a realistic understanding of how unpredictable the world really is. Chapter 3. Never Enough. One of the hardest skills in finance has nothing to do with numbers, analysis, or market knowledge. It is the ability to say enough. Without that skill, even extraordinary success can turn into regret, stress, and ruin. History shows many examples of people who achieved remarkable financial success, but lost it, or lost themselves, because they could not stop wanting more. They were not poor decision makers. In fact, many were highly intelligent, disciplined, and accomplished. Their problem was not failure. It was insatiable ambition. When the goalposts keep moving, no amount of wealth ever feels secure. Modern society often reinforces this mindset. Growth is constantly celebrated. Bigger is seen as better. Higher income, more assets, and greater status are frequently treated as proof of success or even personal worth. But when ambition turns into an inability to recognize sufficiency, risk quietly increases. People who are already successful begin taking chances they don't need to take, exposing themselves to losses that can undo years, or even decades, of progress. The danger isn't wanting to improve your life. Wanting progress is natural. The danger lies in confusing growth with winning and assuming there is no finish line. When you don't define what enough means for you, comparison takes over. There will always be someone with more money, more visibility, or more success. Chasing that moving target makes contentment impossible. Knowing when enough is enough creates resilience. It sets boundaries around risk. Someone who has defined their version of enough understands that protecting what they have can be more important than chasing what they don't. This is not about settling or lowering standards. It's about recognizing that the purpose of money is to support life, not dominate it. Greed often disguises itself as optimism. It convinces people that future gains are guaranteed, that risks don't apply to them, or that past success proves superior skill. This mindset can be especially dangerous during long periods of economic expansion. When markets reward risk-taking consistently, it becomes easy to forget how fragile success can be. Many financial collapses don't happen because people were reckless from the beginning, but because they became overconfident after winning. There is also a psychological cost to never feeling satisfied. Constantly wanting more creates anxiety, not security. The irony is that people who earn the most often feel the least at ease because their lifestyle depends on keeping that income going. The fear of falling replaces the joy of progress. In that situation, more money doesn't increase freedom, it decreases it. Defining enough is deeply personal. It doesn't look the same for everyone. For some, it might mean financial independence and control over their time. For others, it might mean stability, flexibility, or the ability to support family without stress. What matters is not the number itself, but the clarity it brings. Once you know what enough looks like, decisions become simpler. You stop chasing everything and start protecting what aligns with your values. Long-term success often belongs to those who learn restraint. They understand that survival and satisfaction matter more than squeezing out every possible gain. They accept modest returns if those returns come with peace of mind. They avoid unnecessary risks, not because they fear opportunity, but because they respect what they already have. Ultimately, saying enough is less about money and more about behavior. It is choosing contentment over ego, sustainability over short-term excitement, and freedom over status. In a world that constantly pushes for more, learning when to stop may be one of the most powerful financial decisions a person can make. Chapter 4. Confounding compounding. Compounding is one of the most powerful forces in finance, yet it is also one of the hardest to truly understand. On the surface, the idea is simple. Money earns returns, and those returns earn returns of their own. Over time, this creates exponential growth. In practice, however, compounding feels slow, uneven, and often disappointing, especially in the early years. That disconnect between how compounding works and how it feels is why so many people underestimate its power. The biggest results from compounding don't come from extraordinary talent or clever strategies. They come from time. Long stretches of steady growth matter far more than short bursts of brilliance. This is easy to overlook because human intuition is wired to think linearly, not exponentially. We expect progress to be smooth and proportional, but compounding rewards patience in ways that are invisible for a long time and overwhelming at the end. Consider how wealth often grows in reality. For years, it might appear stagnant. Gains are modest, and setbacks feel significant. Then, gradually, and almost without warning, growth accelerates. Most of the wealth appears to be created in a relatively short period, even though it is actually the product of decades of quiet persistence. This leads many people to focus only on the peak and ignore the long, boring buildup that made it possible. This misunderstanding causes two common mistakes. The first is impatience. When results don't show up quickly, people assume their strategy isn't working and abandon it. They move from one investment to another, looking for faster rewards, interrupting the very process that leads to long-term success. The second mistake is overattribution. When someone achieves remarkable financial results, we tend to credit their intelligence or insight, while overlooking the simple fact that they stayed invested long enough for compounding to do the heavy lifting. In investing, consistency often beats intensity. A person who earns average returns for a very long time can end up wealthier than someone who achieves high returns sporadically but can't stick with them. This is why endurance matters more than brilliance. Compounding doesn't require you to be right all the time. It requires you to keep going. The challenge is that compounding doesn't just magnify gains, it magnifies behavior. Good habits sustained over time grow powerful. Bad habits do the same. Small choices, repeated consistently, can lead to results that feel wildly disproportionate to the effort involved. This applies not only to investing, but to saving, spending, and even career decisions. The effects are subtle at first and easy to ignore, which is why they're so often overlooked. Another reason compounding is confusing is that it rarely follows a smooth path. Growth happens in fits and starts. Markets rise, fall, stagnate, and surge. The volatility can make progress feel fragile or temporary. Many people give up during inevitable downturns, not realizing that those declines are a normal and necessary part of the journey. Interrupt compounding too often, and its magic disappears. Patience with compounding also requires emotional control. Staying invested when progress feels slow or uncertain is uncomfortable. It requires faith in a process that doesn't provide constant feedback or reassurance. Short-term thinking clashes directly with long-term growth, and modern life encourages short-term focus, daily news, quarterly results, and instant comparisons. Compounding, by contrast, operates quietly in the background, rewarding those who are willing to ignore the noise. Understanding compounding changes how you define success. It shifts the focus from making impressive moves to making sustainable ones. It encourages avoiding decisions that cut the process short, even if they promise quick gains. It also promotes humility, recognizing that time itself is a major contributor to success, not just personal skill. In the end, compounding is less about finance and more about behavior over long periods. It rewards those who can delay gratification, remain consistent, and allow outcomes to unfold slowly. The hardest part isn't identifying where compounding exists, it's having the patience to let it work. Chapter 5. Getting wealthy versus staying wealthy. Getting wealthy and staying wealthy are two very different skills. They require different mindsets, different behaviors, and often opposite strategies. Many people don't fail financially because they couldn't build wealth. They fail because they couldn't protect it once they had it. Building wealth usually involves taking risks. When you're starting out, uncertainty is unavoidable. You invest in a career, a business, or the stock market without knowing exactly how things will turn out. Optimism, confidence, and a willingness to accept volatility are essential at this stage. Without some exposure to risk, meaningful growth is unlikely. Staying wealthy, however, is far less about taking risks and far more about avoiding ruin. Once you have something worth protecting, the rules change. The goal is no longer to maximize returns at all costs, but to ensure that no single mistake, shock, or burst of bad luck can wipe you out. Survival becomes the priority. This distinction is often overlooked. People apply the same aggressive mindset that helped them grow wealth to the task of preserving it, assuming that what worked before will keep working. Sometimes it does, but often it doesn't. History is full of individuals, companies, and even entire countries that achieved great success only to lose it by refusing to adapt once circumstances changed. The key to staying wealthy is humility. It means acknowledging that the world is unpredictable and that past success does not guarantee future safety. It requires accepting that you cannot foresee every risk and therefore leaving room for error. Cash buffers, conservative assumptions, and lower leverage all feel inefficient in good times, but they exist for one reason: to keep you in the game during bad times. Volatility is another unavoidable reality. Markets fluctuate, incomes change, and unexpected events occur. People who stay wealthy understand that these fluctuations are normal. They don't confuse temporary losses with permanent failure. More importantly, they structure their financial lives so that volatility doesn't force them into irreversible decisions, like selling assets at the worst possible moment. The idea of survival may sound unambitious, but it is the foundation of long-term success. You don't need to make perfect decisions to do well financially. You need to avoid catastrophic ones. Missing out on some upside is far less damaging than suffering a loss you can't recover from. Time only works in your favor if you stay invested, professionally, financially, and emotionally. There is also a psychological component to staying wealthy. As wealth grows, fear often replaces hunger. People become more aware of how much they have to lose. Those who manage this transition, well, don't fight that fear. They respect it. They adjust their behavior to reflect new priorities. They trade some potential growth for stability, flexibility, and peace of mind. This is why many enduring fortunes are built quietly. They don't rely on dramatic wins or bold predictions. They rely on consistency, cautious optimism, and an understanding that the goal of money is not to impress others, but to support a secure and sustainable life. The most successful long-term investors are often those who took fewer risks than they could have, not because they lacked confidence, but because they valued endurance. Getting wealthy requires optimism and risk-taking. Staying wealthy requires paranoia and restraint. Both are valid. Problems arise when we confuse one for the other or refuse to change as our situation evolves. In the long run, the ability to survive matters more than the ability to thrive quickly. Wealth that lasts is not the result of extraordinary returns, but of ordinary decisions made consistently, combined with a deep respect for uncertainty. Chapter 6. Tails, you win. In most areas of life, effort and results seem closely linked. Work harder, practice more, improve skill, and outcomes generally improve. Investing, however, doesn't follow that pattern. In markets, a small number of events often drive the majority of long-term results. This reality is uncomfortable because it clashes with our desire to feel consistently productive and in control. In investing, tails refers to rare, extreme outcomes, big wins or big losses, that sit at the edges of probability distributions. While most outcomes cluster around the average, long-term success is often determined by a handful of extraordinary moments. A few highly successful investments, a few years of exceptional market returns, or one breakthrough business can account for most of a lifetime's gains. This idea explains a surprising truth. You don't need to be right most of the time to succeed. You can make many average decisions, and even several wrong ones, and still do very well if you're positioned to benefit from a small number of big winners. What matters is not consistency in predicting outcomes, but staying exposed to opportunity long enough for those rare events to occur. The challenge is that those winning moments are unpredictable and often uncomfortable. They rarely arrive neatly or clearly. They are usually preceded by long periods of uncertainty, drawdowns, or boredom. Markets spend more time being volatile than they do delivering obvious rewards. This volatility isn't a flaw. It's the price of admission. Many people fail not because their strategy is poor, but because they underestimate how much discomfort they must endure to reach long-term success. They abandon good plans during periods of decline, frustration, or fear, right before the tails that drive results have a chance to show up. The irony is that the very volatility people want to avoid is often what creates opportunity in the first place. In the U.S. stock market, for example, long-term returns have been driven by a relatively small number of strong days, months, or years. Miss those periods because you exited the market due to fear or impatience, and overall performance drops dramatically. The problem is that those strong periods often follow sharp declines when staying invested feels hardest. This leads to an important behavioral insight. Successful investing is less about intelligence and more about endurance. It requires accepting uncertainty, sitting through volatility, and resisting the urge to act on short-term emotions. The biggest gains usually don't come when conditions feel safe or obvious. They come when persistence is tested. Another implication of this idea is humility. If a small number of events drive results, then it's foolish to expect perfect foresight. Even top investors, analysts, and professionals are wrong frequently. What separates those who succeed is not superior prediction, but an understanding that being wrong often is normal and survivable. They structure their decisions so mistakes don't eliminate them from the game. This also changes how we think about talent and effort. We tend to assume that great outcomes reflect consistent excellence, but in markets, extreme success can coexist with many ordinary, or even poor, decisions. That doesn't mean skill doesn't matter. It does mean that outcomes exaggerate skill because luck and timing amplify certain results far beyond what effort alone would explain. For individual investors, the takeaway is not to swing wildly for the fences, but to remain patient and diversified while avoiding catastrophic mistakes. You don't need to chase every opportunity or predict every trend. You need a strategy that lets you benefit when the rare, powerful wins occur, without being forced out during the inevitable dry spells. Tails, you win, reminds us that progress is lumpy, uneven, and slow until it isn't. Long periods of quiet persistence are suddenly rewarded by moments that make all the waiting worthwhile. The hardest part is enduring the waiting. In the end, success comes not from being constantly right, but from being prepared when it matters most. Stay invested, stay patient, and most importantly, stay in the game long enough for the tail events to work in your favor. Chapter 7. Freedom. At its core, the desire for money is rarely about luxury or excess. For most people, the deepest appeal of money is freedom, the ability to control how you spend your time, who you spend it with, and what you choose to do each day. More than cars, homes, or status, this control over time is what people truly seek. Freedom means having options. It means not being forced into decisions by urgency or dependence. When you have financial flexibility, you can say no to a job you dislike, a move you don't want to make, or a situation that drains you. This optionality is powerful because it reduces stress and increases a sense of security far more effectively than material consumption ever could. Time is the one resource money can't buy more of, yet it's the resource people most willingly give up in pursuit of income. Long hours, constant pressure, and delayed gratification are often justified by the promise of future freedom. Sometimes that trade-off is rational and worthwhile. Other times, it becomes a cycle that never ends, working harder to maintain a lifestyle that leaves little room to actually enjoy life. What makes freedom so valuable is its psychological impact. When people feel trapped by bills, obligations, or expectations, money becomes a source of anxiety. When people feel autonomous, money becomes a tool. The difference isn't always income level. It's control. Someone with modest savings but low obligations may feel more at ease than someone earning a high income with no flexibility. Financial independence doesn't require extreme wealth. It requires aligning your spending, saving, and expectations in a way that prioritizes autonomy. That might mean living below your means, keeping fixed expenses low, or building a buffer that absorbs uncertainty. Each of these choices increases the ability to make decisions on your own terms. This perspective also changes how success is measured. Instead of asking, "How much do I earn?" the more meaningful question becomes, "How much control do I have over my time?" A high-paying job that demands total availability may offer status but little freedom. A lower-paying role with flexibility and meaningful work may provide a richer life, depending on personal values. Freedom is closely tied to patience. The ability to delay spending today creates options tomorrow. Saving money is not just about future purchases, it's about future choices. Every dollar saved represents time you don't have to sell. That framing makes saving feel less like sacrifice and more like empowerment. There's also an important social component. People often use money to signal success to others, but freedom is largely invisible. You can't easily see someone's control over their time, only their lifestyle. This leads many to chase appearances while overlooking the deeper satisfaction that comes from independence. Yet when given the chance, most people would choose flexibility over flash. The pursuit of freedom requires clarity about what matters. Without that clarity, money becomes a blunt instrument, chasing status instead of purpose. With clarity, even modest financial progress can dramatically improve quality of life. The goal is not to stop working, but to work by choice rather than necessity. In the end, money's greatest return is not measured in dollars, but in days well lived. The ability to wake up each morning with agency, to choose rather than endure, is a form of wealth that compounds quietly over time. And unlike material possessions, it doesn't depreciate. Chapter 8. Man in the Car Paradox. Picture someone driving an expensive car down the street. Most observers instinctively think about the person behind the wheel, how successful they must be, how well they're doing in life. Rarely does anyone stop to consider the buyer's bank account, savings, or long-term security. This simple observation explains the man in the car paradox. We admire the symbol of wealth, but we confuse it with actual wealth. The paradox exists because people don't really want to admire you. They want to feel admired themselves. When someone buys something expensive, it's often as much about how others will perceive them as it is about personal enjoyment. The problem is that spending money to gain respect usually produces the opposite result. Observers focus on the item, not the owner's financial strength or peace of mind. This misunderstanding shapes a large portion of financial behavior. Status-driven spending can feel rewarding in the moment, but it provides no lasting security. A luxury purchase may boost confidence temporarily, yet it often comes with hidden costs, higher fixed expenses, pressure to maintain appearances, and less flexibility. Over time, these costs quietly erode freedom. The critical insight is that wealth is what you don't see. The money saved, invested, and left untouched is invisible, yet it's the very thing that creates independence and resilience. Conversely, spending is highly visible but says little about someone's true financial health. A person driving a modest car with strong savings may be far wealthier than someone driving an expensive one while living paycheck to paycheck. This paradox also fuels unhealthy comparison. People measure themselves against what others display, not what those displays cost. Social pressure intensifies this effect. When everyone around you appears to be upgrading, homes, cars, lifestyles, it feels natural to assume you're falling behind. In reality, you're comparing your internal financial situation to someone else's external image. Understanding this dynamic helps change behavior. Once you realize that admiration from others is fleeting and superficial, its influence weakens. You begin to see that the peace of mind created by savings, flexibility, and low financial stress offers far greater rewards than public recognition. The satisfaction of security far outlasts the thrill of appearances. This doesn't mean avoiding all enjoyment or never spending on things you value. It means being conscious of why you're spending. Are you buying something because it genuinely improves your life, or because you hope it will influence how others see you? That distinction has long-term consequences. The man in the car paradox reminds us that financial success is deeply personal, not performative. Respect from strangers fades quickly. Control over your life does not. True wealth operates quietly. It doesn't announce itself, seek approval, or need validation. And those who understand this are often the ones who achieve lasting financial peace. Once you stop confusing visible success with real security, your priorities sharpen. You spend less trying to impress and more trying to build. And that shift, away from appearance and toward substance, is where long-term financial strength is quietly formed. Chapter 9. Wealth is what you don't see. Most people judge financial success by what is visible: the house someone lives in, the car they drive, the vacations they post about. But visible spending tells only one story, and often the wrong one. True wealth is not about what you can show others. It's about what you keep for yourself. Wealth is what you don't see. Money spent is gone. Money saved remains flexible. It can absorb shocks, create opportunities, and buy time. Yet because savings are invisible, they're rarely admired. Society rewards display, not restraint. This creates a powerful incentive to spend rather than save, even though saving is the behavior that actually builds long-term security. This misunderstanding leads to a common trap, confusing being rich with being wealthy. Being rich is having a high income. Being wealthy is having control over your future. Plenty of people earn impressive salaries but save little, locking themselves into expensive lifestyles that depend on continued high income. A disruption, job loss, illness, market change can quickly expose how fragile that situation is. Wealth, by contrast, is quiet. It doesn't rely on external validation. It exists in the form of savings accounts, investments, and low obligations. These resources don't just represent money, they represent options. They reduce dependence on any single paycheck or outcome, making life more resilient to change. Saving is often framed as sacrifice, but that framing misses the point. Saving is not about denying yourself enjoyment forever. It's about maintaining flexibility. Money saved today gives you choices tomorrow, choices about work, location, risk, and time. In that sense, saving is an advance payment on freedom. Another reason wealth is invisible is that it reflects what didn't happen. It's the vacations not taken, the upgrades delayed, the purchases skipped. These choices don't create stories or photos, yet they compound into something far more meaningful. Over time, small acts of restraint build a foundation that supports stress-free decisions later in life. Understanding that wealth is what you don't see also changes how you view other people. It reduces envy and comparison. When you realize that outward displays reveal little about financial security, the pressure to keep up fades. You stop measuring yourself against appearances and start evaluating your progress against your own goals and values. This perspective also improves decision-making. Instead of asking, "Can I afford this?" the better question becomes, "What does this cost my future options?" Every dollar spent is a dollar that can't provide flexibility later. Sometimes that trade-off is worth it. Often it isn't. Wealth grows when you consistently err on the side of preserving choice. There is no universal formula for how much to save or what lifestyle to choose. But the principle remains constant. The gap between what you earn and what you spend determines how much control you have over your future. The wider that gap, the quieter and stronger your financial position becomes. In the end, real wealth is not about recognition. It's about peace of mind. It's knowing you have room to breathe, room to adapt, and room to wait. And because those qualities can't be easily seen, they are often overlooked. Yet they are precisely what make money truly valuable. Chapter 10. Save Money. Saving money is often treated as a purely technical exercise. Calculate income, subtract expenses, and invest the difference. But in practice, saving is less about math and far more about behavior and mindset. People don't save because spreadsheets tell them to. They save because saving aligns with how they view control, security, and uncertainty. At its core, saving is a hedge against life's unpredictability. No one can fully anticipate what the future will demand: job changes, health issues, personal priorities, or economic shifts. Because the future is uncertain, saving without a specific goal is not only reasonable, it's smart. Savings give you flexibility to react, not just to plan. Many people feel uncomfortable saving without a clear purpose. They ask, "What am I saving for?" But this misses the point. The most important use of savings is to prepare for outcomes you can't predict. Emergency funds, financial buffers, and long-term reserves exist precisely because life rarely goes according to plan. The value of savings often becomes clear only in hindsight. Saving also has little to do with income level. High earners can struggle to save if spending expands to match earnings. Meanwhile, people with modest incomes often build impressive reserves because they maintain a gap between what they earn and what they spend. That gap, no matter how small at first, is where financial stability begins. One of the biggest obstacles to saving is ego. As income grows, so do expectations. More money creates pressure to upgrade lifestyles, match peers, and signal success. Saving requires resisting that pressure. It means being comfortable making choices that may not look impressive but feel sustainable. That restraint is not a lack of ambition. It's a form of self-respect. Savings also creates psychological benefits that compound over time. Knowing you have a buffer reduces stress and improves decision-making. You negotiate better when you're not desperate. You take smarter risks when failure doesn't mean disaster. You think long-term when short-term survival isn't constantly on your mind. Another important insight is that saving works best when it's automatic and unremarkable. Consistency matters more than intensity. Saving small amounts regularly for a long time is more powerful than waiting for the right moment or perfect opportunity. The habit itself matters more than the size of any single contribution. There is no universally correct savings rate. Different lives require different levels of security. What matters is direction, not perfection. Saving a little and increasing it over time as circumstances allow is far more effective than aiming for an ideal rate and giving up when it feels unrealistic. Saving also protects against overconfidence. When things are going well, it's easy to assume they always will. Savings acknowledge that luck and timing play a role in every success. They are a quiet admission that outcomes are never guaranteed, and that humility is a financial strength, not a weakness. Ultimately, saving is about independence. It buys time, options, and resilience. It allows you to make decisions based on preference rather than panic. You don't save to predict the future, you save to be ready for it. In a world that encourages constant consumption, saving is an act of patience and foresight. It may never attract attention, but it steadily builds the foundation for a life with fewer forced choices and more deliberate ones. And that quiet power is what makes saving one of the most important financial behaviors of all. Chapter 11. Reasonable is better than rational. In theory, the best financial decisions are the most rational ones. They maximize returns, minimize costs, and are backed by data and probability. But in the real world, rational decisions often fail because real people don't behave like spreadsheets. A strategy that looks perfect on paper is useless if it's too stressful, too complex, or emotionally unbearable to stick with. This is why being reasonable is often more powerful than being strictly rational. Rational decisions assume unlimited patience, emotional control, and consistency. Humans have none of those in infinite supply. We panic during downturns, get greedy during good times, and change our minds when uncertainty lasts too long. A plan that requires flawless behavior will eventually break. A reasonable plan, even if theoretically suboptimal, is far more likely to succeed because it accounts for human limitations. Reasonable behavior prioritizes sustainability. It asks not, what produces the maximum outcome, but what can I stick with through uncertainty, fear, and boredom? That difference matters more than any fine-tuned optimization. An investment strategy that earns slightly lower returns but allows you to sleep well at night will outperform a higher return strategy that you abandon at the worst possible moment. This is why personal comfort matters so much in finance. People often chase strategies that worked for others without considering whether those approaches match their own temperament. What looks rational for one person may feel unbearable to another. When discomfort builds, discipline breaks. And when discipline breaks, long-term plans fall apart. Reasonable choices also leave room for error. Rational models often assume precise outcomes and stable conditions. The real world is messy. Markets change, careers shift, and personal priorities evolve. Reasonable strategies don't depend on perfect timing or accurate forecasts. They work across a wide range of possible futures. Another benefit of being reasonable is consistency. Financial success compounds over time, but only if behavior remains steady. Big emotional swings, panic selling, chasing trends, or constantly changing plans interrupt that process. Reasonable people accept that uncertainty is normal and that not every decision will feel optimal in hindsight. they keep going anyway. Being reasonable also reduces stress. When your financial life is built around tolerance rather than maximization, day-to-day noise loses power over you. You're less reactive to headlines, market swings, and social comparison. This emotional stability feeds back into better decisions, creating a virtuous cycle. None of this means ignoring facts or avoiding logic. Reasonable decisions are still informed by data. They're just filtered through realism. They recognize that the best plan is not the smartest one, but the one that survives contact with real life. In the long run, success favors those who remain calm, patient, and persistent, not those who are perfectly optimized. Reasonableness keeps you invested, disciplined, and adaptable. And in a world full of uncertainty, those traits matter far more than theoretical precision. Financial goals aren't achieved by brilliance alone. They're achieved by behavior that can be repeated year after year. When you choose reasonable over rational, you choose durability over elegance. And durability is what ultimately wins. Chapter 12. Surprise. History is shaped by events that almost no one predicts. Wars, technological breakthroughs, financial crises, and social shifts tend to arrive unexpectedly and change the world in ways few models ever capture. Money is no different. The most important financial outcomes are often driven by surprises, not by what we confidently expect to happen. When we plan for the future, we naturally rely on past data. We look at averages, trends, and historical patterns to estimate what comes next. While this approach feels logical, it has a major blind spot. The future is often dominated by events that have little or no historical precedent. The past does not prepare us for the extremes that end up mattering most. Financial forecasts usually fail not because analysts are careless, but because surprise is unavoidable. Models are built around what is known and measurable, while real-world change comes from what is unknown and unexpected. This gap explains why confident predictions so often miss the mark. The danger lies in overconfidence. When people believe they understand the future well, they take risks that assume stability. They use leverage, reduce margins of safety, and lock themselves into rigid plans. When surprise arrives, as it eventually does, the lack of flexibility can cause serious damage. A smarter approach is to accept uncertainty rather than fight it. Instead of asking, "What is most likely to happen?" a more useful question is, "What could happen that would hurt me if I'm unprepared?" This shift leads to strategies that are less dependent on accurate forecasts and more focused on resilience. Surprise also explains why long-term success often comes from broad exposure rather than precise bets. Since we can't know which industries, technologies, or companies will dominate the future, diversification becomes a form of humility. It admits that we don't know where the next breakthrough or disruption will come from, and that not knowing is normal. This perspective applies to personal life as well as investing. Careers change, interests evolve, and priorities shift in ways that are difficult to anticipate. Plans that are too specific can trap people in paths that no longer fit who they've become. Flexibility allows adjustment when surprise reshapes goals. The irony is that the most impactful events are obvious only in hindsight. After the fact, they seem inevitable. Before they happen, they are rarely predicted. This creates a false sense of confidence in our ability to understand the world. We explain the past effortlessly while struggling to predict the future accurately. Recognizing the role of surprise encourages humility and patience. It discourages bold, irreversible decisions based on narrow assumptions. It rewards preparedness over prediction and adaptability over certainty. In finance, success doesn't require forecasting the future correctly. It requires surviving whatever the future delivers. Those who leave room for surprise, by saving, diversifying, and avoiding excess risk, are better positioned to handle outcomes no one saw coming. Surprise will always shape financial results. The question is not whether unexpected events will occur, but whether your decisions have accounted for their inevitability. Those who accept uncertainty don't eliminate risk, but they greatly reduce the chance that surprise becomes ruin. Chapter 13. Room for Error. One of the most important yet underappreciated ideas in finance is the need for room for error. Many financial plans fail not because they are unreasonable, but because they assume everything will go right. In real life, things rarely do. Careers stall, markets fall, expenses rise, and priorities change. Plans that don't allow for mistakes, bad luck, or unexpected events are fragile by design. Room for error is the distance between what could go wrong and what would cause permanent damage. It's the buffer that turns setbacks into inconveniences instead of disasters. Without this margin of safety, even small problems can cascade into life-altering outcomes. People naturally want efficiency. They want their money working at full capacity, earning the highest possible return. But maximizing efficiency often means minimizing safety. High leverage, aggressive assumptions, and tight budgets may look optimal in good conditions, yet they leave no protection when conditions change. The world doesn't reward perfection, it rewards endurance. History makes this clear. Many financial collapses happened to people and institutions that were right most of the time. Their forecasts were logical, their strategies sophisticated. What they lacked was slack. When a rare but severe event occurred, they had no ability to absorb the shock. Being mostly right wasn't enough. Room for error acknowledges two uncomfortable truths. We are not as good at predicting the future as we think, and bad outcomes happen more often than models suggest. This isn't pessimism, it's realism. Acknowledging uncertainty leads to stronger decisions, not weaker ones. In personal finance, room for error shows up in familiar ways. Emergency savings, conservative spending, manageable debt, and long-time horizons. These choices can feel cautious or even inefficient when things are going well. But their value becomes obvious when something goes wrong. Losing a job, facing an unexpected expense, or riding out a market decline is far easier when you're not operating at the edge of collapse. There is also a psychological benefit. When you have room for error, fear loses its grip. You don't need to react immediately to every setback. You can wait, evaluate, and respond thoughtfully. This emotional stability leads to better decisions, which further increases resilience. Room for error is closely connected to survival. You don't need to win big to do well financially. You need to avoid being wiped out. Missing a great opportunity is recoverable. Suffering a loss you can't rebound from is not. This asymmetry is why caution matters so much more than people expect. It's also why patience is such a powerful advantage. Time smooths outcomes, but only for those who can remain in the game. If you're forced to exit, sell assets, take on bad debt, or abandon long-term plans, time can no longer help you. Margin of safety keeps time on your side. Importantly, room for error is personal. What feels safe to one person may feel risky to another. Age, income stability, dependence, health, and temperament all influence how much margin is appropriate. The goal isn't to eliminate risk, but to take risks that won't end your progress if they don't work out. In the end, room for error is not about expecting failure. It's about respecting uncertainty. It's the quiet acknowledgement that life will surprise you, and that success belongs to those who prepare for surprises rather than deny them. Financial plans that endure aren't the most precise ones. They're the ones built with enough flexibility to survive reality. And survival, more than brilliance, is what allows wealth to compound over time. Chapter 14, You'll Change. Long-term financial planning often assumes a stable version of yourself. Your goals, values, ambitions, and tolerance for risk are expected to remain largely the same over decades. But that assumption is flawed. People change, sometimes gradually and sometimes abruptly. Ignoring that reality can turn well-intentioned plans into future burdens. Think about how different you are today compared to 10 or 20 years ago. Your priorities likely shifted. What once felt important may feel irrelevant now. Financial decisions made for a past version of yourself can feel constraining to the person you eventually become. When plans are too rigid, they trap people in commitments that no longer match their values. This is especially common with large, irreversible decisions. Careers chosen for money rather than interest, lifestyles built around peak income, or investments that lock up capital for long periods. At the time, these choices feel rational. They're made with confidence and optimism. But when life changes, as it almost always does, the cost of those decisions becomes clearer. One of the biggest risks isn't failure. It's success in a direction you no longer want. Many people achieve the goals they once chased, only to realize those goals no longer fit who they are. When financial choices remove flexibility, adapting becomes difficult and expensive. This is where humility plays a role. Accepting that you will change leads to better decisions today. It encourages leaving options open, preserving flexibility, and avoiding commitments that assume certainty about a future self you haven't met yet. You don't need to predict who you'll become. You just need to respect that the evolution will happen. Saving and maintaining low fixed expenses are powerful tools in this context. They allow room to pivot, to take a different job, move to a new city, slow down, or pursue something unplanned. Flexibility isn't just financial slack, it's psychological freedom. It reduces the fear of being wrong about your future preferences. This idea also changes how we think about regret. People often regret actions they took, or didn't take, based on assumptions about permanence. Recognizing change as normal makes those regrets easier to manage. You stop seeing shifting goals as failure and start seeing them as growth. It's tempting to believe that clarity today guarantees satisfaction tomorrow. In truth, clarity is temporary. Values evolve with experience, age, relationships, and perspective. Financial plans work best when they accommodate that instability instead of pretending it doesn't exist. None of this means avoiding commitment entirely. Progress requires decisions. But it does mean being cautious about decisions that are hard to undo. The more permanent a choice, the higher the confidence you need. And even then, flexibility is valuable. In the long run, the smartest financial plans are not those that aim for a specific outcome, but those that keep future choices possible. When you acknowledge that you will change, you stop trying to control your future self and start empowering them instead. Money's greatest use is not locking you into yesterday's goals, but giving tomorrow's version of you the freedom to choose again. Chapter 15. Nothing's free. Every financial decision has a cost. Some costs are obvious: fees, taxes, lost income. Others are less visible, but just as real. Volatility, uncertainty, anxiety, and patience are all prices we pay for financial returns. The mistake many people make is believing that good outcomes should come without discomfort. In reality, nothing valuable in finance is free. In investing, the price of higher returns is volatility. Stock markets move up and down, sometimes sharply, often without clear reason. Those swings feel unsettling, and they trigger fear, doubt, and second-guessing. Many people view volatility as a signal that something is wrong, when in fact it is the admission fee for long-term growth. If markets were stable and predictable, there would be no premium for investing in them. The problem isn't paying the price, it's not recognizing it in advance. When people don't accept volatility as the cost of returns, they treat normal fluctuations as personal failures or signs that they've made a mistake. That reaction leads to poor timing, emotional decisions, and abandoning good plans at the worst possible moments. This pattern extends beyond investing. Saving money has a cost too. The price of saving is delayed gratification, the feeling that you could spend today but choose not to. Building a career has a cost: stress, long hours, and uncertainty. Starting a business demands risk, instability, and the possibility of failure. None of these paths are wrong, but pretending they come without trade-offs sets people up for disappointment. A powerful shift happens when you stop thinking of these downsides as penalties and start seeing them as prices willingly paid. Market declines are no longer crises, they're rent. Saving feels less like deprivation and more like purchasing future flexibility. Risk becomes tolerable when you understand that avoiding it entirely means giving up growth. What matters most is knowing which prices you are willing to pay. Different people have different tolerances. Some can endure extreme volatility without losing sleep, others cannot. Some are comfortable delaying gratification for years, others value present enjoyment more. There is no universal right answer. The only mistake is choosing a strategy whose psychological cost exceeds your ability to tolerate it. Many financial failures happen when people attempt to pay a price they didn't fully understand. They invest aggressively during calm periods, assuming high returns are normal. When volatility arrives, they realize the emotional cost is higher than expected. At that point, they don't just pay the price, they panic, often locking in losses. The issue wasn't the strategy itself, it was the mismatch between expectations and reality. Successful long-term investors tend to be very clear about this. They don't expect smooth progress. They know discomfort is part of the deal, so they aren't surprised when it appears. That preparedness makes endurance possible. They aren't braver or smarter, they're simply realistic. This idea also breeds gratitude. When you recognize that luck and randomness play roles in every outcome, success feels less like entitlement and more like a favorable result after paying the cost of uncertainty. That mindset reduces arrogance and increases caution, which in turn improves durability. Nothing's free doesn't mean everything is painful. It means every reward has an associated trade-off. When you understand the trade-offs ahead of time, you regain control. You choose knowingly rather than react emotionally. In finance, the goal isn't to avoid paying a price. It's to pay the right price, the one you can live with, over a very long period of time. Chapter 16. You and Me. There is no single formula for financial success that works for everyone. Strategies that build wealth for one person can fail completely for another, even when both have access to the same information and opportunities. This is because money decisions are deeply personal. They reflect not just goals, but temperament, patience, fear, confidence, and life circumstances. What matters most is not finding the best strategy. It's finding a strategy that works for you. People often search for validation in numbers, models, or expert opinions. While those tools are useful, they can't capture something critical: how you will behave when things go wrong. Someone who can tolerate volatility may thrive with an aggressive strategy. Someone who loses sleep during downturns may abandon that same strategy at the worst possible moment. The difference isn't intelligence, it's psychology. This is where many people go wrong. They copy systems, portfolios, or lifestyles without understanding the emotional cost required to maintain them. On paper, it looks sensible. In practice, discomfort builds, discipline breaks, and long-term plans collapse. The issue isn't lack of knowledge. It's a mismatch between strategy and behavior. Understanding yourself is therefore a financial advantage. Knowing how you respond to stress, uncertainty, and delayed rewards helps you design decisions that are sustainable. A strategy you can stick with for decades will almost always outperform a better one you abandon after a few years. Consistency beats optimization. This idea also highlights why reasonable people can reasonably disagree about money. Two individuals can look at the same data and make different choices, both valid. Their answers differ because their lives are different. Age, family responsibilities, health, income stability, and past experiences all influence what feels safe or risky. There is no universal benchmark for success. Accepting this reduces frustration and comparison. You stop measuring your progress against other people's outcomes and start focusing on alignment. Are your financial choices helping you live the life you want? Do they reduce stress or create it? Do they give you more control over your time or less? These questions matter more than returns alone. It also builds empathy. When you recognize that others are operating under different constraints, judgment softens. Financial behavior stops being a moral issue and becomes a contextual one. People aren't reckless or timid by default. They're responding to incentives and experiences you may not share. The most powerful financial plans share a simple trait. They align behavior with reality. They don't depend on perfect timing, flawless discipline, or constant engagement. They fit the person using them. They allow for mistakes, change, and uncertainty. And because of that, they endure. In the end, financial success is not about beating others or maximizing numbers. It's about building a system that supports your life, your values, and your peace of mind. When your strategy matches who you are, money becomes less of a source of stress and more of a quiet, reliable tool. There is no right way to manage money, only a right way for you. And once you accept that, you stop chasing illusions and start building something that actually lasts.